During the month of February, I used the same 100 shares of stock to sell 4 different covered calls, and I made over $800. One of the best ways I know to generate an income is by selling covered call options and receiving the premium payments. And I really enjoy it when an option contract expires worthless because it means that I can use the same shares to sell another covered call and collect even more premium payments. In fact, I like to think of it like a money printing machine. Join right now to get access to my option trading alert notifications by clicking on the link in the description below. Hey, so you've never sold a covered call and you don't know how it makes money? That's okay, I got you covered. In the next couple of minutes, I'm going to explain how selling a covered call can be used to make money. If you already know how a covered call works, go ahead and skip ahead 3 minutes in this video and I'll see you over there. I'll describe how I sell the option contract to generate an income. I'm going to use myself in this example of selling a covered call. Now I'm going to create a covered call option contract. I'm going to use an underlying stock, ABC Incorporated. I'm going to specify a 1-month expiration date, and I'm going to put a $100 strike price as part of this option contract. And the reason I'm able to write this covered call is because I actually own 100 shares of ABC Incorporated, the company's stock. So this allows me to use that as collateral against the option contract. Now that I showed where a covered call option contract originates from, let me now share a fictitious example and walk you through a covered call option trade. We start off with me on the left and the stock market with buyers on the right. Now I'm going to create a covered call option contract. I'm going to use an underlying stock, ABC Incorporated. I'm going to specify a 1-month expiration date, and I'm going to put a $100 strike price as part of this option contract. And the reason I'm able to write this covered call is because I actually own 100 shares of ABC Incorporated, the company's stock. So this allows me to use that as collateral against the option contract. Now, once I've done this, I offer it for sale on the stock market, and then an interested buyer will let me know that they want to buy my option contract, and so they're going to be willing to pay the premium for that option contract. So I receive the premium, and the buyer then takes ownership or is retained or is associated with the option contract. At this point, now I have to sit and wait for the expiration date. And now let's skip forward 30 days to the expiration date and look at what happens. It's going to be one of two things. So the first result is the market price finishes above the strike price. So in this case, the option contract is going to be exercised. And so my shares will get assigned to the buyer, and I'm going to receive payment for those shares. And I get to keep the premium. Now, the other result could be that the market price finishes below the strike price, in which case the option contract is going to expire worthless. And I'm going to retain the ownership of those shares, so I don't have to give them up. Plus, I keep the full premium that I received for selling the option contract. So let's now take a look at the two possible results from me selling a covered call option contract. Outcome number 1 occurs when the market price finishes above my strike price, in which case my shares will get assigned to the buyer, and in return I'll receive payment for my shares based upon the strike price. Additionally, I will keep the full premium payment that I received for selling the option contract in the first place. The second outcome happens when the market price finishes below my strike price on or before the expiration date. In this case, the option contract will expire worthless. And as a result, I'll retain ownership of my shares. These are the shares that were reserved as my collateral and allowed me to write the covered call in the first place. Additionally, I'll keep the full premium payment that I received for selling the covered call. Okay, cool. Now we understand how a covered call works and how we can make money from it. Let's go on now and talk about the strategy that I'm going to use for selling these covered calls to make money. My strategy for selling covered calls to make money is pretty simple and straightforward. First, I plan to utilize the shares that I already own in my portfolio for the covered call options. Next, I'll sell a covered call using the shares that I have as collateral. Then after the option is sold, I'll monitor the option contract so that I'll know which money-making exit to implement. So first, I could let the option be exercised and profit from the price appreciation in addition to the premium I've already collected. Or I can let the option contract expire worthless so that the shares and collateral are released back to me, and I also get to keep the full premium payment that I received. Or lastly, I can just buy back the option contract to remove the obligation to sell my shares, and I still get to keep most of the premium payment that I've already got paid. So what I really like about this strategy is I sell one covered call, but then I have 3 different ways to make money. So now let me share with you how I take 100 shares of stock that I hold in my portfolio and I sell covered calls over and over and collect over $800 a month in profits. Earlier this year, I acquired 100 shares of Enphase Energy Incorporated, stock symbol ENPH. And now I'm going to use those same 100 shares as collateral to sell a covered call. Here's the transaction record from my account history from when I sold a covered call using 100 shares of Enphase Energy that I currently hold in my portfolio. You can see from this transaction record that I sold a covered call using my shares of Enphase, stock symbol ENPH, with a $175 strike price and an expiration date of February 11th, 2022. Now I submitted the order on February 8th, and it was filled that afternoon at 12:59 p.m. Pacific Time. Now at the time that I sold this covered call option contract, I received $2.50 per share as a premium payment. And so when this option contract got filled, I received a total premium payment of $250. In order to track my progress and profits in this video, I created a simple worksheet so we can keep track of everything. So here you see this first covered call that I sold on February 8th that had the February 11th expiration date, and I received $250 as the premium payment for this 3-day covered call option contract. Now let's take a look at a daily stock chart and zero in on February 10th, 2022, a couple days after I sold this option contract. And we could see that the share price had dropped appreciably from the previous day. In fact, on February 10th, the stock price closed out at $154.64. Now, because the stock price had dropped so much, in fact, it had gapped down. You can see that the price had gapped down. The option price had dropped as well. So I decided at that point to buy back my option contract and close it out using a buy to close technique. Now, if you're not familiar with a buy to close technique, it's actually a pretty simple concept to grasp. All I'm doing is purchasing back my option contract that I had opened initially when I sold the covered call. So here you can see the transaction record from my account history where I actually purchased the option contract back. So I'm buying back my option contract for ENPH that had the $175 strike price and the February 11th expiration date. You can see here, I submitted the order to buy to close on February 10th, and it was filled that morning at 8:36 a.m. Pacific Time. Now at that time, I needed to pay 25 cents per share in order to close this option contract. So when this buy to close was executed and filled, I ended up paying a total of $25 to close out this option contract. So with the buy to close completed, let's update my spreadsheet so we can see how I'm doing. So on February 10th, I used a buy to close on that covered call that I originally sold that had the expiration date of February 11th. Now I had to pay 25 cents per share, or a total of $25 to close out this option contract. So that made my new account balance $225. So buying back my covered call option contract that I originally sold is in essence saying I'm no longer interested in making that deal. So I'm paying back or buying back my option contract that I initially sold. And what that will do is it'll make that contract go away. The shares that were reserved as my collateral now become released and allows me to keep those shares so I don't have to worry about them being assigned if the option contract were to be exercised. But now that I have those shares again, I can actually turn around and sell another covered call. Now, of course, the downside to buying back my option contract is that I have to actually pay money to do that. But as you saw from the worksheet, I received $250 for selling the covered call, and I only had to pay back $25 to close out that option contract. So the net effect is I walk away with a net profit of $225.
A few moments later.
Well, now that I've closed out that covered call option contract, my shares are no longer obligated, and so I'm free to do what I want with them. In fact, I'm going to go ahead and turn around and sell another covered call using those same exact shares. Take a look here. So about an hour after buying back my option contract and releasing my obligation to sell my shares, I'm going to use those same exact shares now to sell another covered call. So you can see I'm selling a covered call with a $175 strike price and an expiration date of February 18th of 2022. And I submitted this order on February 10th. Later that morning, it was filled at 9:21 a.m. Pacific Time. Now at that time, it was paying $2.50 per share in premium. And so when the option contract that I sold got filled, I received a total premium payment of $250. Now let me update the worksheet so that it reflects the second covered call option contract that I sold. So I sold the second covered call option contract on February 10th, and it had an expiration date of February 18th. Now it had the same strike price as before, $175, and at the time it was paying $2.50 in premium, so I received a total premium payment of $250, which brings my account balance up to $475 for this 8-day covered call option. Well, now let's fast forward a little bit, go back to the daily chart and look at February 15th, which is 3 days before the expiration date. And we could see here that the stock price was still hovering right around $150 per share. In fact, it closed out the day at $154.29. Well, that's a little bit over $20 off my strike price. And as such, the option price for this contract had dropped appreciably as well, and so I was able to buy back this option contract. Here's the transaction record from my account history where you can see that I successfully executed a buy to close for this option contract. This option contract was filled February 15th at 9:18 in the morning, and I had to pay 20 cents per share. So my total cost to close out this option contract was $20. I went ahead and updated the spreadsheet so you can see this buy to close and how it affected my account balance. So on February 15th, I successfully executed the buy to close out the covered call option that I had sold previously. I ended up paying 20 cents per share, or a total of $20, to close out this option contract, making my new account balance $455. So with this buy to close, I successfully closed out my second covered call option contract. And now I can reuse those same shares to sell another covered call. So now let's take a look at this third covered call that I sold. Now because the market price for Enphase Energy was still hovering around $150 per share, I needed to lower my strike price in order to collect a premium that I thought would make it worth the risk reward. So I set my strike price at $170 and an expiration date of February 25th. So this third covered call was filled on February 15th and it had an expiration date of February 25th, making it a 10-day option contract. Now at that time I was able to collect $1.30 per share. So when this option contract got filled, I received a total premium payment of $130. Now let's jump over to a daily chart to find out what happened to this stock on the expiration date of February 25th, 2022. As we look at the daily chart, we can see that this stock price closed out at $153.73 on the expiration date. Now, just as a reminder, my strike price was $170, but the closing price was $153.73. So the market price finished below my strike price, and as a result, this option contract expired worthless. I went ahead and updated the worksheet to reflect this latest covered call that I sold on February 15th that had an expiration date of February 25th with the $170 strike price. Now the premium at the time was $1.30 per share, so when this option contract got filled, I received a total premium payment of $130, bringing my account balance to $585. Now, as I showed you, on the expiration date for this 10-day covered call option contract, the market price finished below my strike price, and so this option contract expired worthless. And as a result, my shares that were reserved as collateral were returned back to me so I could reuse them and sell another covered call. Plus, I got to keep the full premium amount of $130. So at this point, there was one trading day left in the month. So I wanted to see if I could use those same shares to sell another covered call and collect even more premium. Fortunately for me, I was able to use the same shares to sell a fourth covered call. You could see it here, where I sold the covered call with a strike price of $172.50 and an expiration date of March 4th, 2022. Now, I was able to submit this order on February 28th, the last day of the month, and this option contract got filled at 6:55 a.m. Now, at that time, it was paying $3 per share, so when the option contract got filled, I received a premium payment of $300. Here's the updated spreadsheet that includes the fourth covered call that I was able to sell on the last day of the month, February 28th. Now, it has an expiration date of March 4th, 2022, and a strike price of $172.50. Now, because the stock price is trending higher, I was able to collect a higher premium payment, and so I received $3 per share for selling this covered call option contract, for a total premium payment of $300. And as I add this payment to my account balance, I come up with my new ending account balance of $885. In this video, I shared with you how I was able to sell 4 different covered calls using the same shares and managing my trades, and all the while collecting premium payments all along the way. And so my end result is I ended up with $885 as a result of all my trading activity. So by actively managing my option trades, I was able to sell 4 different covered calls using the same shares and collecting money all along the way. And hopefully now you can see and understand why I like to think of this as a money printing machine. You can get immediate access to my trade alert notifications by joining my Simple Trading Room community. Be sure to use the special link that I've included in the description below so you can join in on the action. There's one last thing before I end this video. Now, making profits and generating an income from option trading is a great thing, but keep in mind that all gains made from trading are considered income and are subject to applicable tax considerations. So every month I save a portion of the profits that I earned in order to pay for my federal and state taxes. So please consult with your CPA, licensed financial advisor, and or tax preparer regarding the tax liabilities for your unique situation. If you're still watching this video, I just want to say thank you so much. I really appreciate it. And I also want to wish you good luck and lots of success with all of your trades.